Hi guys, devang from Equialpha.com. In the stock market, there are around 2000 plus stocks that are listed. Yes, 2000 is a big number. In this video, I'll tell you how you can categorize these stocks into different set of categories and the characteristics of each of these categories, so that whenever you are making any investing decisions, you can divide that stock into particular category and make your investing decision very simpler. So let's start. The first category is cyclical stocks. Cyclical stocks are basically the stocks that moves up and down as the economy is also moving up and down. Now you might think that everything is cyclical then, because if the economy is doing good, every company will earn, and if the economy is doing bad, every company will do bad. That's true, and that is the reason why all the major industries, you can say 95% of the industries fall into the cyclical category. But there is a trick here. This cyclical industry can be categorized as two categories, which is high cyclicals and low cyclicals. If you see high cyclicals, these are basically infrastructure companies, cement industries, steel industries. These all get changed very fast as the economy moves. The intensity of their change is very high, and that's why they are called high cyclicals. Low cyclicals are basically the discretionary set of goods like AC, fridge, washing machine, laptop, electronic items, which will depend basically on people's income. If you are having money, you will spend on fridge. If you have money, you will spend on television. If you have money, you will spend on laptop. And if you don't have, even after that, you will spend something. The pro tip here is high cyclicals are extremely risky. They are never made for wealth creation, and that's the reason majority of these companies, they never progress in a linear fashion. Their stock charts will go like this and this. They are not made for long-term wealth creation. However, if you catch them in the right cycle, they can give you a lot of money. That's why high risk, high return. The second one is secular stocks. What does that mean now? These are basically the companies which are just completely reverse of cyclical industries. Cyclical industries depends high on the economic condition. However, secular stocks have no relation with the economy. Now, think for a moment that what would be the type of stocks that will be coming upon here. Yes, healthcare, pharma industry, and to a little bit extent the FMCG industries also. A simple example here is that if somebody is having a heart problem, he'll go to a doctor, he'll go to a hospital, the doctor will write him the medicines, he'll buy that medicines. He will not wait for the economy to correct and the economy to be in good condition so that he can take care of his health. Right? That's why healthcare and pharma are two such industries which have no relation with economy. Even if the economy is doing bad, people are bound to spend on medicines. These will include all the different pharma companies and also the laboratory companies, the pathology labs like Metropolis, Lalpath Labs. These all are secular stocks. Now it's time for the pro tip. The pro tip here is, this is a very good sector to invest in. That doesn't mean that you just simply invest in any company within that sector. You need to look onto these companies, but these companies will have very good fundamental health, and the demand for these products are always there 24/7. The third one is penny stocks. I know you keep on searching on social media about what are penny stocks, which penny stocks to buy, which penny stocks can give multi-bagger returns. So I'll take a bit onto this. Penny stocks are usually stocks which are in single digit or mid double digit. Now that sounds amazing. That's what you are searching for. That's so cheap. Let's buy. That's the only thing that you should buy. No, you should not do that. Let me tell you why. These are usually the companies who have a lot of fundamental problems and their financial health has been deteriorated over years. You might find that the promoter has done some fraud, or there is some corporate governance issue, or the companies are high on debt, and because of that the company is now in bankruptcy proceedings. Now the story starts up here. You think that earlier it was 200 rupees and now it's only at 2 rupees. So अब 2 रुपए से 3 रुपए होने में कितना टाइम लगेगा? The pro tip here is penny stocks are made for wealth destruction. Yes, I repeat, it's made for wealth destruction, and the reason for that is majority of the companies you will find in penny stocks highly deteriorated in health. Secondly, you might find that there is some turnaround stories always going on with these penny stocks. Turnaround stories like companies changing, now the company is growing, he is buying his stake in this company, that big investor is buying into this company. You will always find some stories going on around these penny stocks. These are highly speculative in nature and are highly volatile. They move by 5-10% each day, and that's why people get attracted to it. End result is the story keeps on moving up and up. Your wealth will start moving down and down. As a result, you will say investing is gambling. However, the truth is you went into those stocks knowing that they're fundamentally bad, knowing that there is high chances of fraud just for some greed. So stay away from penny stocks. The fourth category is multi-bagger stocks. Multi-bagger stocks are best in category. Multi-bagger stocks basically means a stock that has the potential to grow multifold, or the stock that has already grown multifold. A stock that was of 10 rupees and is now 20 rupees is called as a two-bagger. The number of times it grows, the number of bagger it becomes. These are fundamentally very strong companies, growing companies, are low on rate. And if you want to know more onto this, I have already made a separate video for this, which you can see up in the card. Fifth category is turnaround companies, and this is a very hot category. When I say hot category, it means that every retail investor is hunting for these stories. Story of a stock that was doing very bad and now there is some sudden change, maybe in the management, maybe in the product, or whatever the case is. And now people think that this stock and this company will change in entirely and the company will create huge returns in the future. That's why it is called turnaround companies. A bad company turning out to be good. A loss-making company turning out into profits. A fundamentally very poor health company turning around into good companies. Now these set of companies are very popular and everybody is looking for these companies. However, let me tell you one fact about this. Most of these turnaround stories usually never happen and just remain into stories. For example, you can see about Quality Limited. It was again a turnaround story from a B2B business to a B2C business, and the story never happened. As a result, it's now into bankruptcy. There are many stories around turnaround companies. These stories are very similar with the penny stocks, and some turnaround companies can be categorized into the penny stock companies also because of the price. But this doesn't mean that every turnaround companies will be into single digit, double digit. You will find the companies into triple digit also, maybe double digit also. There is no such price range for these turnaround companies. It can be at any moment. But the pro tip here is be aware of these stories. Most of the turnaround stories are simply the stories without any mind, and they never happen. People will keep on buying thinking that the company will turn around. For example, Reliance Communication, for example, Reliance Power. Many were onto it that the company will turn up, and the most popular saying behind this is company band thodi hogi. People think that the company will not be closed down, it's a big company and something good might happen, the price has already fallen, so it is bound to turn around. And stories will always support at that point of time. Pro tip here is to stay away from turnaround companies. It can destroy your wealth. These stories will just play up with your mind and you will not look at the facts in that case. So look onto the facts and stay away from turnaround companies. The next category is commodity stocks. These are extremely volatile in nature. Commodity stock simply means companies which deal in commodities like sugar, rubber, cotton, etc. How to look whether a particular thing is a commodity or not? Understand, the consumers buy up these products like salt, sugar, rubber, cotton not on basis of brand but on basis of lower cost. Sugar is sugar. There is not much brand power into that. For example, if you are buying a shoe, you look onto the brand, that you are buying it of Relaxo, you are buying it of Red Tape, you are buying it of Levi's or whatever it is. However, when you are buying sugar, you don't look onto brand. When you are buying cotton, you don't look onto the brand. When you buy steel, majority don't look onto the brand, and due to that, these set of companies doesn't have any brand power. Consumers buy because of the lower cost and not the brand. And because the customers buy it on the basis of the low price, there is always a price competition among these companies. Not only that, the overall price is determined not by a particular company but by the entire demand and supply scenario. For example, if the demand of sugar is more and the supply of sugar is less, simply people will be paying up more for buying the goods because the supply is less. And if the supply is more, the product is abundant and everybody can get the product now at a lower price. They don't have to pay more for the additional product. Due to that supply and demand mismatch, the price keeps on moving up and down. If the demand is more, the price will also be increasing and everybody in the industry every sugar company will earn at that point of time. However, if there is a lot of supply, that will simply decline the price and the entire industry will get hurt by that manner. So the pro tip here is, these commodity companies are extremely volatile and these are never meant for long-term wealth creation. You cannot keep it forever. However, let me tell you one thing. If you are able to time the cycle correctly, at that point you will earn very quick money on this. So it is high risk, high reward category. If you are able to do it correctly, it is immensely rewarding, but it's extremely difficult. Why? Because at the best of the time you need to sell and at the worst of the time you need to buy, not the reverse that we usually do. So we usually buy up when everything is looking good and we sell up when things start turning out bad, right? However, in this case it's a bit different. You don't do that. If you will do that, you will simply ruin up your money. You need to buy at the worst time and you need to sell at the best time, because after a good period of time there will be sudden change in the industry supply and demand and the curve will change very fast, and that's why I said that these are extreme volatile in nature. Okay, so these will include sugar companies, cement companies, this will also include rubber, cotton, all those commodities around. The seventh category is of blue chip companies. Blue chip companies are usually historically proven large cap companies and these are usually household names. If you don't know much about blue chip companies, then I'm dropping the link on the card so that you can look onto the blue chip companies entirely. I've already made a video onto it, so I'll not repeat into this. However, the pro tip for blue chip companies is, many think that these are extremely safe companies. However, when the worst of the time will come, they will also fall. Comparatively less, but yes, they also fall, and these are not safe companies. Understand, nothing is safe into stock market. If you are here for safety of capital, then you are at the wrong place. Only you can do two things. First, understand the risk, and the second things, have measures to control the risk. That's the only two things that you can do up here. So that's about the 7 categories, and you would have understood by now to which categories to focus upon. The category to focus here is cyclical stocks. No, that's not. Commodity stocks. That's not. The answer is multi-bagger stocks. But we need to first understand with regard to multi-bagger companies that what are the characteristics of multi-bagger companies. Not just you can pick any company and see that it's multi-bagger. As I told, that these are fundamentally strong growing companies. You now need to understand what's fundamentally strong and what's a growing company. For that, I've dropped a link on the card which you can see right now, which tells you the secrets of multi-baggers, how to pick up stocks in the long term. So you can go through that videos and look upon how is multi-bagger companies, and it's the area to which most wealth gets created. So I hope you like this video. If it provide you insight, then just press the subscribe button and hit the bell icon right now so that you can receive the updates on regular time. Thank you for watching. See you, Devang Maheshwari.